Two people buy the identical $400,000 house on the same street. One pays it off in 15 years. The other takes 30 and never once feels stretched. By the time the dust settles, one of them has handed the bank roughly $300,000 less in interest. But the other sleeps easier every single month. More cash in the budget, more room to breathe. Here's the part that trips people up. Neither of them made a mistake. There's no secret right answer that a smart buyer is supposed to just know. The same loan that's brilliant for one person is a trap for another. And the difference has almost nothing to do with the interest rate on the page. That's exactly why this choice quietly catches careful, intelligent buyers off guard. They obsess over the rate, lock in the term that sounds responsible, and only later realize they optimized for the wrong thing entirely. Some of them lock themselves into a payment that strangles every other goal they have. Others coast on a comfortable payment for decades and quietly pour a small fortune into interest they never had to pay. So let's actually settle it. By the end of this video, you'll know the 5 factors that genuinely decide which loan is right for you. Not for some textbook borrower, but for your income, your stability, and your stomach. No hype, no one-size-fits-all rule. Just the real trade-off, laid out plainly. Start with the 2 numbers a lender quotes you, because this is where the confusion begins. The 15-year loan usually carries a lower interest rate than the 30-year. The reason is simple: the bank gets its money back faster, takes on less risk, and rewards you for it. In mid-2026, the 30-year fixed average around 6.5%, while the 15-year sat near 5.85%. That's roughly a 0.65 percentage point discount, comfortably inside the historical range of about a quarter point to 3/4 of a point. So the 15-year wins on rate. But here's the twist that catches people. A lower rate does not mean a lower payment. On an illustrative $400,000 loan, the 30-year runs about $2,530 a month. The 15-year jumps to about $3,340 a month, roughly 32% higher. Think about why. The shorter term crushes the exact same debt into half the time. So even at a better rate, the monthly bite is far bigger, because you're paying off twice as much principal each month. The rate is the seductive number. The payment is the one that actually lands in your bank account. Now stretch those payments across the full term, and the whole picture flips. The 30-year loan keeps you in debt twice as long, so even at a slightly higher rate, you're paying interest for an extra 180 months, 15 additional years of feeding the bank. Watch what that does to the total. On the same illustrative $400,000 loan, the 30-year costs roughly $510,000 in total interest over its life. Let that sink in. That's more than the house itself. You're effectively buying the home twice and handing the second one to your lender. The 15-year, by contrast, costs about $202,000 in total interest. That's a gap of roughly $308,000, over $300,000, handed to the bank, purely for the privilege of a smaller monthly payment. This is the single strongest argument for the shorter term. You're not just paying off the house faster, you're buying a fundamentally cheaper loan. The higher monthly payment isn't a punishment. It's the discipline that locks in those savings. Every dollar you're forced to put toward principal is a dollar the bank never gets to charge you interest on again. Total interest is the headline. But how the loan amortizes, how each payment gets split, matters just as much, and it's the part almost nobody pictures correctly. Every mortgage payment divides between interest and principal, and early on that split is wildly lopsided on a 30-year. Because interest is front-loaded, most of your payment in the early years goes to the bank, not to actually owning your home. Here's the number that surprises people. On a 30-year loan, the moment when more of your payment finally goes to principal than to interest doesn't arrive until around year 19. For nearly 2 decades, the bank is taking the bigger slice. On a 15-year, that crossover comes around year 3, and that gap shows up directly in your equity, your real ownership of the home. After 5 years on the illustrative $400,000 loan, the 30-year borrower has paid down only about $26,000 of principal. The 15-year borrower has knocked out roughly $97,000. That's nearly 4 times as much real ownership in the same 5 years. And that faster equity isn't just a feel-good number. It's forced savings sitting in your walls. It's money you can borrow against or cash out later, or simply count as net worth that's genuinely yours. It also matters if life forces your hand. Sell or refinance early on a 30-year, and you've spent 5 years mostly renting your own house from the bank. The 15-year borrower in that same spot walks away with real money. So far, the 15-year is winning on paper, but the 30 years higher total cost is buying something real and easy to overlook. Breathing room. That roughly $810 lower monthly payment on the illustrative loan isn't gone. It's cash that stays in your budget every single month. It can become an emergency fund, retirement contributions, childcare, or simply the cushion that lets you absorb a layoff without ever risking the house. A 15-year contract is binding. You must make that larger payment whether the month went well or fell apart. There's no asking the bank for the smaller version when times get tight. And here's the middle path that most people completely miss. You can take the 30-year for its low required payment and then voluntarily pay extra toward principal in the good months. You shorten the loan on your own terms, but you always keep the option to fall back to the smaller payment when money gets tight. That's the real trade. The 15-year forces discipline on you. The 30-year rents you optionality. The 15-year says you will save. The 30-year says you may save, and you may also survive a rough year. Which one is worth more depends entirely on how stable and how stretched your income really is. The strongest case for the 30-year isn't comfort, though. It's math. If you reliably take that roughly $810 monthly difference and invest it, instead of spending it, a diversified portfolio could outgrow the guaranteed interest savings of the 15-year. The logic holds because, over the long run, stock market returns have historically beaten mortgage rates. So the money you're not pouring into the loan could be working harder somewhere else. In one illustrative scenario, at an 8% average annual return, 3 decades of investing, the difference can rival or even exceed the shorter loan's payoff. But 2 giant asterisks apply, and they're the whole ballgame. First, it only works if you actually invest the difference every month and never rate it. Most people don't. The $810 quietly dissolves into a nicer lifestyle, and the math evaporates with it. Second, the 15 years savings are guaranteed and risk-free. Market returns are not. A guaranteed 5.85% return, which is what paying down that loan really is genuinely hard to beat after you account for tax and risk. So here's the honest answer. The 15-year wins on certainty. The 30-year, paired with disciplined investing, can win on expected value. But only for the disciplined. Be ruthlessly honest with yourself about which one you actually are. So let's bring it all together. A 15-year mortgage carries a lower rate and saves a huge amount of lifetime interest, roughly $308,000 on an illustrative $400,000 loan, while building equity nearly 4 times faster in those critical early years. The trade-off is a payment about 32% higher that you're locked into, no matter what the month brings. A 30-year mortgage costs far more in total interest, but it frees up your cash flow, hands you a margin of safety, and gives you the option to prepay on your own terms. In the end, the decision comes down to one tension: certainty versus flexibility. The 15-year wins on guaranteed savings and forced discipline. The 30-year wins for buyers who genuinely value breathing room, or who will truly invest the difference. Match the loan to how stable and how stretched your income is, not to a single headline number. If this made the 15 versus 30 decision feel clearer and a lot less like a test you were supposed to already know the answer to, hit subscribe. That's exactly what this channel is for. The money stuff nobody ever sat you down and explained. And before you lock in any loan term, make sure the house itself fits your budget. Next up, video 29 on house affordability, which breaks down how much home you can actually afford using the front-end and back-end debt-to-income rules. I'll see you there.